The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He is one of my favorites. He needs no introduction whatsoever. Rick Rule, welcome back to the Rebel Capitalist Show.
Thank you so much for having me back, George. I look forward to visiting with you in front of your audience again.
Now, the first thing I'd like to discuss is gold. And it's kind of almost out of favor right now, believe it or not, although the central banks are still, or the Fed at least, is still doing 120 billion of quantitative easing every single month, and we've got $5 trillion deficit in 2020. Who knows what it's going to be? We just had a $1.9 trillion stimulus. We've got Janet Yellen saying that she's going to spend over $1 trillion out of the TGA, which means new money supply. Yet gold has been going down, and I guess it's because of real interest rates. So can you kind of give us your opinion on gold and how the real interest rates affect the market, maybe what you see in the future?
Well, that would certainly be my argument, George. I've, in the 45 or 50 years I've been in the gold trade, I've noticed that the primary mover for gold is fear, but more specifically, fear of people's ongoing purchasing power, the purchasing power of their savings in conventional instruments. And the most important determinant from my point of view has been the both nominal and real interest rate on the U.S. 10-year Treasury, which is the world's benchmark security. You'll note, looking back over 2 years, that the period that saw the decline in the 10-year from 200 basis points to 60 basis points corresponded with an increase in the gold price from $1,100 to $1,900. The subsequent increase in the interest rate on the U.S. 10-year Treasury from 60 basis points to 150 basis points coincides with first the plateau and then the decline in the gold price. So I think it's completely consistent, if not perfect, to equate strength or weakness in the gold price with real and nominal interest rates. It's important too, George, to understand that there's some variability around that depending on crisis. And we've enjoyed 40 years of relatively benign economic climate with declining interest rates and reasonably good debt equity markets and reasonably good economic conditions. So people are more less cautious, more confident than they would have been in a less benign economic circumstance. People need to understand in terms of gold that even at 150 basis points, the real yield on the U.S. 10-year Treasury is negative. Mm-hmm. The trailing estimate of the Congressional Budget Office is that the purchasing power of the currency declines at 1.6% compounded. So what the U.S. government is really saying is that if you give them money now, they will give you back less in the future, precisely 10 basis points less. So I think the case for gold is still very good. It's just that the case for gold is less obvious. For me personally, the decline in the gold price, since I would like to buy a bit more gold and some more gold equities, is very positive. I believe that the wind is in gold sails, and I'm confident enough in my thesis that I am happy rather than unhappy to see the price of gold decline nominally and the price of the gold equities decline fairly substantially because it gives me an opportunity that was certainly missing in July and August to acquire high-quality gold equities at reasonable prices. They had, I think, probably gotten ahead of themselves, and I think they're now very well within the buy range using normal valuation characteristics.
Right. So if the 10-year Treasury yield going up means lower gold prices, typically, where do you see the interest rates on the 10-year being capped, like yield curve control, or do you see the inflation rate starting to exceed the rate on the 10-year, or how do you think that plays out to where the gold price reverses course?
That's the $64 trillion question. I am one who believes that the Fed is allowing the interest rate to rise so that they'll have some ammunition to play with if they need to in the future with regards to the economy. And I personally believe that they'll need to. I believe, too, that as the yield on the 10-year flows through to different credit markets, as an example, the 30-year mortgage market, the consumer durable and automobile market, and also the funding rate for federal, state, and local governments as they refund their short-term obligations. I believe, I hope I'm wrong, but I believe that the economy isn't going to be strong enough to sustain those higher interest charges. I think that there's a very large constituency of voters and others who love artificially low interest rates, and I think that those constituencies will put pressure on their elected representatives on both sides of the aisle. And the elected representatives on both sides of the aisle, I think, will be very accommodative with regards to pressing for lower interest rates and also continuing with the stimulus packages. I believe myself that the gold bull market continues until you see an end to quantitative easing, which may never happen, until you see a U.S. budget deficit that is substantially less than the economic growth rate, the GDP growth rate of the country, and until interest rates revert to mean. By the way, reverting to mean, if you look back over 30 or 40 years, the interest rate on the U.S. 10-year Treasury has been between 150 and 200 basis points real versus the CPI rate of inflation, which would call for, if we reverted to mean, a 400 basis point or 4% yield on the U.S. 10-year Treasury. My suspicion is that that would send a real shock into credit markets and would probably be, in this political environment, unsustainable.
Right.
The bottom line behind all of that stuff is I suspect that what we're seeing right now is a buying opportunity for gold rather than structural weakness in the gold or gold equities markets.
Yeah, I think that's very consistent with my view as well. So the Fed sits back and says, okay, we're going to keep the Fed funds rate at zero. The short end of the yield curve is going to be right at zero because there's so much demand for those T-bills in the repo market and dollar funding. That's kind of a different ball game. But we're going to let the long end of the curve continue to go up, although we're buying $80 billion of treasuries every single month through QE. But aside from that, we're going to let it go up until something breaks. And then once something breaks, whether it's the stock market going down and, the Fed says in a disorderly manner, that's the verbiage they always use. So until the stock market goes down disorderly by, let's say, 20% or 30%, or they start to see cracks in the economy, whether it's auto loans, whether it's the housing market, then the Fed comes in and implements yield curve control by buying as much as they possibly can or need to of the long end of the curve, in which case the market is offsides because, as far as the gold market, because they're expecting the real rates to continue to increase or the treasuries to go up, and all of a sudden the Fed says, nope, we're doing yield curve control, then all of a sudden you get a huge price swing in gold. Is that kind of how it might play out, you think?
Yeah, I think that's the half of it. I think the other part goes like this. Institutional investors worldwide manage now substantially in excess of $100 trillion. Traditionally, 60% equity, 40% debt. And that's worked traditionally. When the economy is soft and equity prices fall, the interest rate falls, and so the bonds appreciate. The capital appreciation of the bond offsets the decline in equities. Right. That works fine if you have a positive yield, if you have a positive carry on your bonds. But if you don't have a positive carry on your bonds, if you have a negative carry on your bonds, all of a sudden there's sort of $50 trillion a year in bond holdings in institutions that are giving the holders a negative real yield, and they disintermediate out of the bond market. And some of it probably, I'm not trying to say that 40 or 50 trillion goes into gold. That's wrong. But some amount of it goes into bonds. Goes into gold. And right, if you're talking about a fairly small fraction of a number that's $50 trillion, that does an interesting thing to the gold price. Right. We discussed this. I don't know if you remember, but the last time we talked about the fact that gold, precious metals and precious metals related equities are very underowned historically.
Yeah, right.
They comprise less than half of 1% of savings and investment assets in the United States. against a 3-decade mean of between 1.5% and 2%. So I'm not one of those really crazy gold bugs who suggest that, gold is going to win the war against the US dollar. I just think it's going to lose it less badly. I think we're going to revert to mean. And if we revert to mean, for the reasons that you and I have just talked about, we're talking about a tripling or quadrupling of demand for precious metals and precious metals equities in the largest savings and investment market in the world. And that's precisely what I think is going to happen. Nothing dramatic, just a reversion to 40-year mean.
Yeah, right. So the pushback I know I'm going to get from a lot of people are to say, well, Rick, they're not going to do that anymore. They're going to go into Bitcoin instead. Bitcoin is the new 10-year Treasury competitor. So what would you say to that?
I think that Bitcoin and gold are complementary assets, except around the fringes. There's a group of people in the world who think that gold is going to go to $15,000 and they think that Bitcoin is going to go to $1 million or something like that. God bless them both. I mean, I get it. The speculative fringe will do what they do. I think they're very different types of asset. The utility afforded by Bitcoin as a medium of exchange is the size of the network. I get that. But the very volatility in Bitcoin that attracts speculators reduces its utility as a medium of exchange unless you live your whole life denominated in Bitcoin. With the volatility that you see now, if you go to buy a bag of groceries with Bitcoin, you don't really know what you paid, and the grocer doesn't know what he or she got.
Right.
The utility of gold is very different. It isn't a promise to pay, it's payment in and of itself. And the lack of volatility discourages speculators, but it is useful in terms of medium of exchange and store of value. And in truth, George, when you look at either of them, the market cap either of precious metals or of Bitcoin, relative to the $450 trillion in savings assets that exist around the world, I think the market capitalization of Bitcoin is about $1 trillion.
Yeah, right.
The truth is that they're both pimples on an elephant's behind. They really, really, really don't matter except for the sort of fortunes of, in most cases, speculators.
Yeah,
for the rest of us, they're probably compatible asset classes and not in competition.
Yeah,
I would say that the competition for gold, at least in North American markets, as a store of value and because of the liquidity, even as a medium of exchange, is the S&P 500. I think the real competitors for precious metals and precious metals related assets in an inflationary environment will come to be the S&P 500. And I believe there's lots and lots and lots of room for both.
Yeah, I agree. I've always seen them as completely different asset classes. I always tell people what I do with my own portfolio is set it up in a 10-80-10. So the 10% is insurance. So for me, that's physical gold. The 80% is what I consider investments. That's something that pays you to own it. It's like a dividend paying stock or real estate. And then the other 10% is just speculative. It's not paying you to own it. There's just good asymmetry there, where I think Bitcoin is perfect along with some other things. So I've never seen them as competing assets.
Yeah, that's how I feel. You and I will get lots of hate mail as a consequence of that.
Yeah, the gold will piss off the gold people, and will piss off the Bitcoin
people, right? Yeah. The youngsters will call us fossils, and the old guys will just say we're out of touch. So
let's talk about silver. And what I want to think through is how silver is not only a precious metal, but also an industrial metal. And I know there's such a strong argument for copper and EVs. I guess an EV takes like 4 to 5 times the amount of copper. And if we do move towards EVs in the future, there just flat out isn't enough copper right now. There's going to have to be an incredible amount of additional supply, and who knows where that's going to come from, therefore price goes up. But how does silver play into a world where that's transitioning into EVs, or a world where Biden is doing a Green New Deal type of thing?
Good questions. With regards to silver, it has two drivers. One is, as you suggest, the industrial driver, because silver is used for a lot of things. It's used for microelectronics. Importantly, you can't have the solar revolution without the reflective properties of silver. Yeah. And what many people don't know is that it's a wonderful germicide. So it's very useful for treating wastewater, as an example. And continued utilization of silver for industrial purposes is important to the silver market, not as important as investment demand. In my experience, I've lived through 2 prior precious metals bull markets, real ones. What you notice is that gold moves first because it moves based on fear. When gold has established the momentum, midway through the bull market, towards the end of the bull market, silver kicks in spades. Right. Historically, and I'm not saying it has to happen this time, historically, when silver moves, it moves much further and much faster. And the assets that are sort of end of cycle crazy movers are the silver equities, because the market capitalization of the high quality silver equities combined is just insufficient to accommodate the inflow of generalist capital when we get into the middle or late stages of precious metals bull market, which I think we're approaching. Copper is an interesting story.
Yeah, I wanted to talk to you about that.
My suspicion would be, without the revolution in electric vehicles, that copper will do extremely well for 2 reasons. The first is that 1.2 billion people in the world have no electricity at all, but they're getting hooked up very, very rapidly. They want to live the way that you and I do, and increasingly some of them can afford it. Right. So separate and apart from vehicles, increasing urbanization, increasing housing standards, people who have the ability to go from from shopping in the market every day, as an example, to having a refrigerator, having light bulbs, all of those things require copper. Electric vehicles are the icing on the cake. You and I think about electric vehicles because we live in the United States and we can afford the transition, if we want to, from an internal combustion engine to an electric engine. It's going to be a very long time before electric vehicles make inroads in places like Bolivia, Zambia, places like that. Yeah. But the truth is that increase in population and the increase in living standards in emerging and frontier markets will be an enormous driver for copper. The second driver for copper is that society has underinvested in copper exploration, copper development, and copper production for 3 decades. And part of the increase in the copper price that I think you're going to see is a consequence not so much of demand creation, but rather supply destruction. We are living off deposits that were discovered 30 years ago, permitted and built 20 years ago. And as you know, every day that you mine a mine, your business gets smaller. You can't pour water and fertilizer and have that hole grow more copper. It doesn't work like that. Increasingly, you have permitting delays, around the world in the copper business. There's a very nice copper deposit in the United States called Resolution. Billion-ton deposit's been known about for 20 years. It will probably be 10 or 12 years in the permitting phase and may never actually ever be permitted. Mm-hmm. Then you need to put up $6 or $7 billion to build it. It'll take some time to do that. So the ability that the market has to create incremental supply to meet the increased demand is something that society would have had to begin to address 10 or 12 years ago. I am personally believing, although it looks like I may be wrong, that we're due for a little bit of an economic slowdown. I'm always, whenever I see an economy funded by artificial liquidity and debt, I'm always afraid. I joke I've called accurately 17 of the last 3 declines. So it wouldn't surprise me to see the economy slow down a little bit and the copper price slow down a little bit too. But if you're looking out 4 or 5 years, simply the ascent of mankind, given the inability of the mining industry to radically increase copper supplies, means, I think, that we're going to have higher copper prices than people think looking out 4 or 5 years.
Yeah, that's the struggle I think a lot of my viewers have, is they're really bullish on copper, but they see how much the price is run. And they're like, man, should I really chase it here? Or should I wait for a pullback? That's always kind of the internal debate in their mind.
Guilty as charged. The whole sort of reflation trade is something I'm very afraid of. I thought, and in fact, I said on your show 7 or 8 months ago, that the oil market was an absolute no-brainer at $20 or $30 a barrel. I just thought it would take 3 years. I didn't realize it would take 4 months.
All right.
to have that trade go from $30 a barrel to $65 or $70 a barrel. And my own belief is that we run some risk as investors and as citizens to believe that the economy can recover without digesting the impact of a 10-year bull market that we enjoyed in the 2009 to 2019 timeframe. That's a very, very, very long recovery. Or before we factor in the structural damage done to the economy by the COVID-19 virus. It could be that all of us want recovery so badly that we manage to maintain our confidence, even though that confidence is generated mostly by liquidity.
You're right.
I'm cautious about all this, George. I understand myself intuitively, because I'm an old man, that there is a difference between the words liquidity and solvency in the English language. And an economy that is moving because it's liquid rather than because it's solvent is one that scares me. I've seen it happen before, and I've gotten it wrong before. So it'll be interesting to watch it play out.
Yeah. What I've been trying to think through a lot lately is kind of this idea that we've gone from trying to answer economic questions to where now we need to start trying to figure out political questions, which is far harder. And the reason I say that is because, even going back to March 2020, we always say, well, there's a Fed put, there's a Fed put, there's a Fed put. Well, the Fed came in with guns blazing back in March, and it didn't do anything. I don't know if you recall, but the Fed had a meeting set up for Wednesday. They had an emergency meeting on Sunday. They dropped interest rates down to zero. They announced they were going to do up to $1 trillion a day in repo, QE infinity, and the market on Monday still went down by 1,000 points. And the market didn't start going back up until the fiscal side of the equation came to the table, and the government said, okay, now we're doing this next stimulus package. Okay, so we got that, number one. Then number two, I did a video the other day that where I looked at a study, the Bureau of Economic Analysis. So this is a government deal. It's not some libertarian think tank or something. And they said that the incomes overall in the United States on aggregate total from Q1 of 2020 to Q2 went up by 30%. 30%, while unemployment goes up to, call it 20%. Just in January of this year, 2021, incomes across the United States went up by 10%. 10% in 1 month, and because of all the government transfer payments.
Yep.
So you see what is when you're thinking through commodities and trying to figure out inflation, deflation, obviously the amount of goods and services going down because of supply chain constraints and the lockdowns. There's less businesses now than we had prior to COVID. But you have more income, then you think, when will that stop? And it becomes a political question. So since you have so much more experience than I do you think the way that American politics are set up, do you think we'll just continue these stimulus, another 2 trillion stimulus, 3 trillion stimulus, 10 trillion in stimulus, or do you think there's going to be political gridlock to where they can't push that through, and we'll start to see the deflationary pressures that we would see in a free market come to fruition?
I don't think that we will see any political gridlock with regards to spending.
Okay.
The Republicans are just as eager to buy votes as the Democrats. They buy them differently, but they're just as eager to buy votes. One function of democracy I've learned in my old age is that a constant function of democracy is a war on savers by spenders. Spenders are very numerous and savers are very scarce. And if you're a politician, the idea that you would you would rely on a scarce constituency rather than a massive constituency is fairly silly.
Right.
My suspicion is that debt and deficits and stimulus continue as long as they can get away with it. If we have a treasury auction where nobody shows up, if they go to blow out, $50 billion worth of 10 years and nobody shows up to buy them and the Fed has to buy them all, then you have a very different circumstance. Then you have a circumstance where the private market looks at the Fed and says, okay, either game on or game over. that would be one of those analogous black swan style events that the bankruptcy of Bear Stearns is an example occasioned. Am I saying that's going to happen? No, I'm just trying to address your question. The truth is, George, I'm afraid that most of the electorate is innumerate. If you went into a town hall meeting in most places in the United States and said to them, the on-balance sheet liabilities of the United States government is $28 trillion, first of all, they wouldn't know how many zeros that was.
Yeah, they wouldn't know what a balance sheet was.
And then if you told them that the off-balance sheet liabilities, Medicare, Medicaid, all that kind of stuff was $120 trillion, it wouldn't mean very much to many of them. I read a heartening and perhaps cynical study not too long ago, where they interviewed a bunch of young people in their mid-20s. I guess they're called millennials now, and more of them believed in extraterrestrial life than believed that they'd get paid their Social Security. So that generation might be more realistic than our generation, but I think our generation simply believes that what it wants is more important than what it can afford.
Right.
Mencken, H.L. Mencken famously said, that you understand elections really as advanced auctions of stolen property. And the circumstance that we're in front of is a bunch of warring elites looking to plunder the savings of the rest of society. The easiest part of society to plunder is the unborn. So you vote yourself a benefit now, and you put it on the tab for the kids to pay. And I know that sounds very, very, very cynical, but the easiest way I have of answering or addressing the question that you just asked is observing the political process in that fashion.
Yeah, now I think the narrative too, Rick, with MMT is that we're not even requiring the future generations to pay the tab. The government can just create the money to pay the tab. We don't even have to worry about it. Our only constraint is inflation. That's it. Because the government is a currency issuer. They're not a currency user. So I think that, back in the day, people thought that way, that even the politicians, said, okay, well, we're going to be burdening future generations. But now I don't even think they're aware. They're not even thinking in those terms.
I think in the period of time that we exist in right now, after a bull market beginning by my count in 1982, so a 41-year-long bull market, people are occasioned to believe that the Fed has their back, that while actions that you and I take have consequences, that the actions that they take do have consequences. And I hope I'm wrong, to be honest with you. I would love to see a circumstance where we could offset the deflationary pressures associated with having too much debt by fine-tuning the creation of new currency units. That is to say, through counterfeiting. Understand, George, that if you did quantitative easing, it would be called counterfeiting, and they'd put you in a slammer. If Congress does it, it's highly popular and it gets them reelected. It goes, however, to the debasement of the currency, I think. And I do suspect that the Fed is going to achieve its goal, or the Congressional Budget Office is going to achieve its goal of 2% plus inflation. I think you have to be very careful what you wish for. Because once you let that genie out of the bottle, she's kind of hard to put back there. And that probably deserves discussion too, George. I know you didn't ask me the question. I'm no economist. I'm a credit guy. But when they talk about the increase in the cost of living as being 1.6% a year,
yeah, right.
Those guys shop somewhere I don't shop.
They don't go to Motel 6.
Yeah, you remember that story. I mean, I just built a house, and mercifully, I got in early enough. The price of lumber in the Pacific Northwest is up 125%. Price of cement is up 50%. The price of copper is up 50%. Skilled trades labor in the Pacific Northwest is up 35%, and yet the CPI The increase in the cost of living is up 1.6%. The weirder thing from my viewpoint, and I'd like your listeners to think about this, George, the Congressional Budget Office stated cost of living doesn't include tax. Now, I guess if I didn't have to pay the tax, I wouldn't bitch so much about the index. But, the idea that the biggest single component of most people's cost of living isn't factored in the cost of living. And the fact that they haven't done they do hedonistic adjustments. So if your computer is better than it used to be, but it costs the same, they treat it as though it costs less. They should have to do a negative hedonistic adjustment. They should have to look at the deficit and say that they're going to have to increase tax to pay off that deficit. So the net present value of that obligation ought to have a current value in terms of the CPI, because it's an obligation of the chattel, which is the actual way of describing citizens.
Yeah.
And I would urge your listeners not to confuse the CPI stated rate of inflation with the necessary devaluation of the purchasing power of their savings. I think it's a useful psychological measure. I think it's a factoid. I think it's something that's accepted in the market not because it's true, but rather because it's believed to be true. And I would urge your listeners to think about their own future differently.
Yeah, I always try to compartmentalize the two, because you've got the government stated CPI, and unfortunately that's what the market pays attention to. Like the gold market as an example, where they're seeing real interest rates as the 10-year treasury compared to the CPI or the TIPS market, something
right.
like the delta there. They're not looking at groceries. So you got to look at, your own expenses and how to maintain your purchasing power with the stuff you buy every day. And that's probably humming along at, 5, 6, who knows, 8%. I mean, Shadow Stats pegs it at 10% if you measured it the way even the government themselves did prior to 1980. But then if you're trying to figure out what's going to happen to the price of XYZ, then you kind of have to use the government statistics. So it gets, tricky.
I suspect that's a near-term, long-term phenomenon, which is to say that everybody's confident and everything goes along well until it doesn't.
Yeah.
That's my own supposition. I also, in my decrepitude, believe, as you suggested, it makes some sense to insure. I would love to be wrong. I would love all the things that concern me with regards to debt and deficit and democracy and Democrats and Republicans, all this kind of stuff. I would prefer to sit up here in my dream house and not worry about anything at all. But my preference doesn't matter much in this circumstance. If you think about the fact that, as an example, in terms of the discussions that you and I have been having, if you think about gold as an example, as an insurance policy, having 5% of one's net worth in gold, just as an example, the duration and dimension of gold bull markets is very misunderstood. The first one that I was in, the gold price ran from $35 to $850. The second one, it ran from $253 to $1,800 or $1,900. In a circumstance where stuff got really lousy, I'm not saying this is going to happen, but it would be easy for the gold price to run from 1,700 to 6,000 or 7,000.
Yeah.
And you get an awful lot of insurance for a very small premium. If you had a bond portfolio and the bond portfolio got cut in half the way it did in the 1970s, the increase in purchasing power that you would enjoy from the gold would offset most of the loss of purchasing power that you encountered as a consequence of the value of your bond portfolio getting cut in half. And I think it's important that people begin to think not in terms of certainties, which is what they want, but rather in terms of probabilities and possibilities, which assumes that you're willing to accept a fairly broad variety of outcomes, and that your portfolio is bulletproof enough that irrespective of the nature of those outcomes, that you're going to be okay.
Yeah, right. Yeah, and I think it goes just the way to put it in simple terms, one question for everyone to answer for themselves is, do you think debt to GDP in the United States is going to go up or down? Simple question.
Right.
If you think it's going to go down, then maybe you should have a little less gold. If you think it's going to go up, maybe you should think about buying a little more. I mean, that's pretty much as basic as we can get it.
Right.
Hey, Rick, what about uranium? We had in our first conversation, I think you said that was a when question. It wasn't an if question. And since that time, it's gone up a bit. I don't know how much though. I remember back in March, I bought everything I could as far as the commodities, which included uranium. And I know what I bought has gone up, maybe doubled or something like that. But I don't know where it's gone since we've spoken. So what are your thoughts on uranium?
The uranium juniors, the small cap uranium stocks, are ahead of themselves. They've doubled, tripled, and they've doubled or tripled on a very, very small move in the spot market from sort of 24, 25 to 28, 29.
Yeah.
The junior uranium stocks are clearly ahead of themselves, as is evidenced by the fact that they're all issuing stock as fast as they can to raise money. They figure the money's worth more than their paper, which is always a bad sign. The uranium price is illusory. You see the spot market, which is about 25% of volumes. The contract market, which is very opaque, is beginning to firm fairly substantially now. So you're seeing short-term transactions take place in the sort of $28, $29 range. You're seeing term contracts take place in the 47, 48, 49, 50 range.
Oh, wow. Okay.
So the uranium market is firming right in front of our eyes. It isn't firming fast enough to justify the increase in share prices among the narrative-driven juniors. But the circumstance that we described on your show is absolutely taking place. You know how you said that you can simplify it in terms of debt to GDP? You can simplify uranium too. If you're American, if you look in the US market, uranium is about 15% of total electricity supply, 20% of baseload supply. And in the next 5 or 6 years, there's no substitute for it. You just can't. Solar is not baseload. Wind is not baseload, So either the price of uranium goes up to the price that allows the industry to earn a reasonable return on capital employed and their cost of capital, or the lights go out. Those are the two choices.
Yeah, right.
The International Energy Agency suggests that the fully loaded cost to produce a pound of uranium worldwide, I don't just mean cash cost, I mean fully loaded, between 55 and 60 bucks a pound. So either the price of uranium basically doubles, or the lights go out. And so your readers need to ask themselves which of those two circumstances they think is most likely.
Yeah, exactly. And what I find interesting is whenever I talk to guys like yourself that are pros and have been in the business for, especially commodities, for many, many decades, you notice that they talk about the demand side, but they really get focused on the supply side. And what's interesting is when I talk to amateurs, they seem to get just hyper focused on demand and almost ignore the supply components. Is that something that you see as well? And why do you think that is?
It isn't something that I'd thought about it, but I suspect if you're focused on the demand side, what you're focused on is trading. What you find in commodities is because they're so capital intensive and so cyclical that you need to focus more on the supply side, because a supply shortfall can't be changed quickly. If, as an example, the price of bread rose, a bakery'd put on a third shift.
Right.
They'd buy more milk, they'd buy more butter, they'd buy more flour, they'd buy more salt, and they'd kick out a whole bunch more bread. And they could respond to the pricing signal by increasing supply. Try and permit a new uranium mine. Never mind finance it and build it. In terms of uranium, the demand doesn't have to increase at all because the price that we pay for uranium isn't sufficient to maintain supply. And when you balance supply and demand by reducing supply and the market firms, the market way overshoots because the industry can't increase production fast enough. The other thing that surprises people about commodities is the insane utility offered by commodities. As an example, the budget to produce electricity in a nuclear power plant may be 6%, 7%, 8%, the price of the fuel, after the depreciation of the building, after permitting, after the lawyers, all that kind of stuff. So if the price of uranium doubles, it has absolutely no near-term impact on demand, because so much utility, or rather so much money, is generated from a small amount of product. Right. Similarly, as an example, in platinum, it takes maybe $150 worth of platinum or palladium to put a catalytic converter in place to sell a $60,000 or $70,000 car. If the price of the commodity doubled, for the next 5 years, it would have absolutely no impact on demand. So the suggestion that you have is to look at the supply side, because if you aren't able to maintain supply, the price rises, and the price can rise for a long time without impacting demand at all.
Yeah, even if demand is going down.
Correct.
I mean, you could have demand go down, and everyone's like, "Oh my gosh, the price is going to tank," because they completely ignore the supply side. But the supply is going down faster than demand.
Right.
You still have the same type of imbalance there, and especially to your point in a commodity, that to get more of the commodity, even if we need it desperately right now, it ain't going to happen for 5 years, for 10 years, something like that.
Yep.
Yeah, maybe it's because we just live in a digital age where it's like, Rick, let's throw up a website. Oh yeah, we'll just put it up in 10 seconds, and people just assume that it's like that with
I think what happened in commodities is that we invested so aggressively in the means of production in the 60s, 70s, and the first half of the decade of the 80s that we set up a supply surplus that we've been living on ever since. Okay. Our assumption throughout the species really is that we have very, very, very ample supplies, and we do. Technology will allow the real price of commodities to fall over time for a very long time, but there can be hiccups in that wonderful scenario that last up to 20 years. And those hiccups can be painful for those who didn't prepare, and very pleasant for those who did.
Yeah. Okay, so you talked about the paper price of uranium compared to the
spot price. Yeah,
the spot price. And the question that I always get in the comments, or the back and forth, the dialogue, is the price of silver.
Yep.
And the price of gold. But I think recently it's really been silver because of all the Wall Street bets, the Reddit forum with GameStop and whatnot. So what's your position on, is the silver price manipulated by the banksters in the options market? Is that even possible with the way the futures contracts are set up, or is there always going to be kind of an equilibrium over the long term because of the market dynamics in play, or what's your read on that?
Well, I don't think your question's an or question. I don't think manipulation is possible in the very long term, but I believe that all markets are manipulated in the short term. And in the short term, the silver market, because of its structure, is uniquely easy to manipulate. If you have a market where the futures market, as an example, trades 200 to 250 times the amount of silver available for good delivery in a day,
right,
not in a week or a month. I mean, the COMEX can trade 250 times the good delivery availability every day in the futures market. So I don't want to make any allegations. So let's just do a suppose. Let's suppose that the Bank of Rick decided to screw with the silver market. The Bank of Rick could layer in a bunch of futures trades, fairly highly leveraged futures trades, 90-day settlement, 120-day settlement, 180-day settlement, 2-year settlement. And nominally, at least, the futures market trades off the physical market. The Bank of Rick, having put these, let's say, short positions.
So you're selling those contracts into the market. Yeah. When you say short in the commodities or futures, people think stocks. So they think you're like borrowing stocks and then selling them So,
Right.
but with the futures, there's an expiration, and there's different variables at play.
Correct. So, maybe buying puts, maybe selling above market calls, and doing that by posting margin, and then borrowing 20 million bucks worth of silver, physical silver, and selling that all at once, late at night when there aren't very many bidders. Obviously, an action that you don't go into to maximize the value of the silver you sold, but rather to provide the maximum downside pressure that you could on the physical price to impact the futures.
Right.
Then you settle out your shorts and call it a day. I remember way back in the day, George, in the 70s, when the silver market was manipulated up. Manipulators always do what's easiest. So if there's an upside bias in the market, they'll run the trade backwards. They'll go long the futures, and they'll buy physical silver late at night when there's no sellers around. You've seen that the U.S. 10-year Treasury market, the deepest securities market in the world, can be liquidated. The LIBOR market can be manipulated. The mortgage-backed securities market can be manipulated. The idea that you wouldn't manipulate a market that is as disjointed as silver, given the disproportionate trading volume in the futures rather than the physicals market, would be naive.
Right.
It would be really naive. I never believed that the kids, as I call them, the young people, the Reddit crowd, the Wall Street bets crowd, could impact a market as big as silver. When they moved over from GameStop, which had an infinitesimal market capitalization, to the silver market, I thought, boy, these kids are going to get spanked. I didn't understand that the amount of physical silver that they were willing to buy or their impact in the futures market could be such that they could create tightness in the silver market. But they've actually done that. Certainly, your coin dealer friends will tell you that retail denominations in physical silver are sold out. I mean, you can get them by paying a $15 an ounce premium, but that's a rather ugly premium, on a $25 ticket. For a long time, although there was a shortage of material available in the retail market, at Sprott, and I think we may have been the largest buyers of physical silver in the world in the last 12 months for our trusts, we were able to get wholesale quantities of silver in wholesale denominations, institutional denominations, with no trouble at all.
I see. So it's just smaller, right?
A couple things happened. The demand for retail product outpaced supply at the same time that COVID shut down the mints and the refiners. Yeah. The guys who take 1,000-ounce product and re-refine it into 1-ounce product. So we had sort of a perfect storm there. That being said, there's tightness. We're still able to get silver ourselves, but it isn't as easy as it once was.
That's a great point, because I think the average investor just sees the difference of what the spot price is, or let's say the futures price of silver, compared to what they can buy a coin for at their local pawn shop or something. And they say, oh my gosh, this discrepancy, something has to be going on. And there is different dynamics there. But to your point, the price of buying a ton of silver may be far, far, far less than buying an ounce of silver.
Yeah, and we're buying in not just quantities, but we're buying product that's 400-ounce product or 1,000-ounce product.
Yeah, right.
And that's been much more available. Now, what we have done, anecdotally, I don't know this to be true, but I believe it's true, for us, because all of the silver we buy, we put in the Royal Canadian Mint. We, unlike the ETFs, we can't have deposit receipts or delivery receipts. We have to have physical silver, not a promise of silver. We have to have silver. So, we sort of cleaned out what was available in Ottawa, other holders at the Mint. And then I think we cleaned out Toronto. And then I think we cleaned out Toronto. Gold is pretty easy. You stick it on a plane because it's pretty expensive relative to weight, and you ship it.
Yeah, right. Silver, how do you?
Silver, preferably you move it by truck in pallets. And, when anecdotally we began to clean out New York and Boston, simply because of its weight, it's difficult and expensive to move from, say, London or Frankfurt or Zurich to Toronto. So we've been able to do it. Being as I'm not sure we are, but I think we may well have been the biggest buyers of physical silver in the world for the last 12 months. So we get extremely good service.
Yeah.
If anybody's going to get filled, we're going to get filled. But
yeah, well, that's a neat story, and I would have never connected those dots where it's not just about the physical silver price, but the quantity of the physical that you're actually buying. So how would it? Let's just say that the physical silver price for even a large quantity was in excess of the futures market. How does that come to an equilibrium? Like, what are the market dynamics at play that would prevent that from continuing for a long period of time?
Your listeners are going to hate this too, because there's dreams that they're going to bust the COMEX. That won't happen. The COMEX is run for the benefit of the members of the COMEX. And if we had a circumstance where there would be a failure to deliver, the COMEX would change the rules, like they did on the hunts. They might require 150% margin on the long side for silver, or they might declare force majeure. They might suspend the silver market and go to cash settlement at a price that was related to market, except that there was no market. So they would establish for themselves what they thought a market clearing price should be and cash settle. The idea that we could cause them some very anxious moments. The suspicion is that in the futures market over 180 days, if people ask for good delivery of 150 to 200 million ounces of silver, we could definitely take them to force majeure. Now, I'm making that number up.
Right,
I don't know. But the idea that we would crash the market and that the price of silver would go to $300 or $400 on a failure to deliver short squeeze, I think is not cynical enough. I think you need to understand the nature of institutions and markets and how self-serving they are.
Yeah. Okay, that's incredible insight, and that explains a lot of things. I think not only for me, but I think the viewers will get a ton of value there. So I know we're running short on time, Rick. I wanted to briefly go over and you touched on it just momentarily there, the difference between the ETFs and the DLD and your product, which is PHYS, if I'm not mistaken. A lot of people come to me and say, hey, George, where should I buy physical gold? Because I always talk about that 10-80-10 thing. And I always say, it's great to buy physical, but I'm traveling so much, I don't have the ability to do that. So I personally buy Rick's product because I like Rick. And but how is it different? Because one thing that we didn't touch on is that even if you have your gold go up in nominal terms, if you have to sell, you're still going to have to pay cap gains tax on that, so it could decrease your purchasing power. But I think that the way your products are set up, there's a little bit different tax strategy there. Am I right or wrong?
Yeah, you've asked a bunch of questions, and without devolving into a commercial, I would be a
commercial. Yeah, that's why I teed it up for you there.
I would say the advantage of our product over owning physical metal, as an example, is simply that it's easier and cheaper. There's no premium. If you go to buy silver right now from physicals dealers, you're paying an enormous premium over spot. And if you go to sell it, you're not going to get spot. You're going to get a discount to spot. That's how the dealer makes his or her money. We trade on the New York Stock Exchange. You don't have to go to a dealer. It's a click of a mouse. And unlike the ETFs, which are allowed to take deposit receipts or delivery receipts, which is to say they're allowed to hold paper silver, we have to hold silver. And in our product, large institutional holders, I forget what the number is, might be 1,000 ounces. Anyway, they can present our certificates for delivery. In other words, they're redeemable for silver.
Right.
Which keeps our product never selling at too great of a discount, because if it trades at a discount, the arbitrageurs sell the silver, buy our units, present our units for redemption, and fill the short. So it tracks fairly well. In fact, tracks very well. I would urge, not just for regulatory purposes, but rather for practical purposes, people who are interested in that to go to our website. The tax advantage, and God knows I'm no tax lawyer. The tax advantage is that if you own physical silver or surrogates for physical silver, including the exchange traded funds,
Like GLD?
the tax man regards those as collectibles. And so you're taxed, depending on your state, at the collectibles rate or the ordinary income tax rate. If you're owning our trust, you're treated as a shareholder of a trust, which in turn owns silver, and you're taxed at the capital gains rate.
Yeah,
that's
what I was thinking.
So for taxable U.S. taxpayers, there's a benefit to our product, which is better described at our website.
Yeah. Okay, Rick. Well, that kind of leads me into my next question. I was going to thank you for your time as always. I love our conversations. You're one of my favorites. You've been since 2012, and I can't thank you enough for how much value you've given me over the years and how much I've learned just from watching your videos and everything you've put out there and the few times that we've been able to talk. So thank you so much. And for the people who want to find out more about what you do, they should go directly to the website and they can find out everything there. Is there somewhere else?
I'll make it very easy and give them an incentive.
Oh, yes.
Any of your viewers who want to initiate discussions with me, go to a website, sprotusa.com/rankings. Enter, if you'd like, your natural resource stocks at that website. Names and symbols, please. And please, no pot stocks, no tech stocks, nothing I don't understand. I personally will rank your stocks 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues where I think that my comments might have value. Once again, sprotusa.com/rankings. Enter your stocks. I will rank them. I'll send them back by email. No charge, no obligation. To the extent that I don't get too many questions, I'll answer the questions. I should also tell you that as of today's date, March 15th, 2021, I have resigned most of my responsibilities at Sprott. I'll still be reachable through this website. I'll still be a director, all that kind of stuff. The upshot of that is that I'll be able to come onto your show in the future, much less constrained by regulation in terms of what I can say. So I look forward to our future discussions unconstrained by compliance.
I look forward to that as well. And I will tell the viewers that or the listeners that this is not what Rick's saying is legit. He actually does this, and because I have a investment forum, Rick, called Rebel Capitalist Pro. Right. And so it's a subscription, monthly subscription fee. And we do live streams in there where I take Q&A along with Lynn Alden and Chris McIntosh. And we got a question the other day from a member on the live stream saying, oh my gosh, I emailed Rick Rule and he actually emailed me back. And I gave him a list of my stocks and he commented and it was so amazing. And he says, what do you guys think about what Rick says? So Rick is actually doing this. It's not an assistant. It's legit, and you got to take advantage of it. So it's such a cool thing. And this person was so excited, Rick, that you did that. Really
and you have to be patient. I'm about 500 behind right now. So after this interview, I'm going back to fixing that.
All right, Rick. Thank you very much. I can't wait to do it again.
Pleasure, George. Thank you.
Hi, guys. I'd like to invite each and every one of you to join me in Miami this June 11th through the 13th for Rebel Capitalist Live, the investment conference. And this is not over Zoom. This is face-to-face. I'm bringing a lot of your favorites from the Rebel Capitalist show to Miami under one roof to speak, to give you the knowledge you need to increase your personal freedom, to become a better investor and make larger returns over the next few years when we have this financial uncertainty that's being caused by the Fed and the government. And finally, it's going to give you an opportunity to really take your understanding of macroeconomics and the world around us to the next level. We've got some incredible speakers lined up that are going to completely blow you away. People like Mike Maloney, Jason Hartman, Ken McElroy, Lynette Zhang, Mark Moss, Brent Johnson, Jeff Snider, just to name a few. The tickets for this event are really going to sell out fast, so make sure you go to Rebel Capitalist Live right now to get all the details and to reserve your spot. We need to come together as a group, as a community, especially after what we dealt with in 2020 and 2021, so we can learn how to build wealth and thrive in a world of out-of-control central banks and big governments. And we need to do this as a group, as a community of fellow rebel capitalists. So don't waste any time. Head over to rebelcapitalistlive.com, and I will see you in Miami.